The loan officer you called today won't give you a straight answer about today's mortgage rate. What is up with that? Coming up right now, I'll tell you on the Arizona Report. Welcome to the Arizona Report. My name is David Meek. I'm a licensed Arizona real estate broker, and I am here to answer a question that was presented to me recently by a client. He called me after reaching out to a couple of loan officers to just ask a simple question. The simple question was, what is today's interest rate? And he did not get a straight answer, and he was very frustrated. But there's a reason for that, and I'll talk about that in this episode, number 13. Why can't I just get today's mortgage rate? If you are not qualified and pre-qualified, and if you don't know about pre-qualification, go back and look at episode 11 on my YouTube channel about what is pre-qualification. Pre-qualification is an opportunity for you to take your financial documents, your bank statements, your tax returns, take them to a lender, have them rubber stamp your file, and approve you for a home loan. But if you haven't done that step yet, it's very difficult for any loan officer to quote you today's mortgage rate. And the reason is there are a blue million loan scenarios that with 1,000 different interest rates. And if you have not identified yet where you fit, the loan officer at best can only quote you a range of interest rates for that day. He or she might say, well, today I can get you a rate between 3.5% and 4.375%. It just depends on your scenario. Here's why there's a wide range of interest rates on any given day. Number one, your credit profile. Do you have good credit or bad credit? Are you a high risk or low risk borrower? That will sway your interest rate very far. Your higher credit score buyers will get a very low interest rate. The lower credit score buyers will pay a higher interest rate because there's more risk associated with those at the bank level. Next, down payment. How much down payment are you putting down? Are you doing a 3.5% down FHA loan, or are you putting down 20, 30, 40% on a conventional loan? Banks love to see the skin in the game. They love to see a large down payment, and 20% down is a magic threshold. It's not mandatory. You can get in for 3.5% for an FHA loan, or in some cases 0% down on a USDA loan. I'll talk about those in an upcoming episode. But the more money you put down reduces the risk for the lender. So if you have 20% down in a property, chances are if the market adjusts down and that house loses value, you're not going to walk away, and you'll probably still be in a situation where you're making your mortgage payment. Higher down payments equal less risk for the lender. Next, what type of home? What's the use of this home? Is it a vacation property? Is it a rental property for you? Or is it your primary residence, the house you're going to live in? The first two scenarios, the vacation property and the rental property, come with more risk for the lender, so you're not going to get a competitive interest rate in that scenario. You will get the best interest rate if this is your primary residence and you are going to live in the property. That's another factor. Next, is this a condo or is this a single-family home? Single-family homes traditionally have lower interest rates. They're lower risk to the lender. Condos come with an extra layer of risk, so your interest rate on a condo is going to be higher than a comparably priced single-family home. Next, the loan term. How long are you borrowing the money for? Is this a 15-year rate, or is this a 30-year term? 15-year term or a 30-year term for your loan. How long are you borrowing that money for? Traditionally, 15-year rates, because it's a shorter period, there's less risk, they have a lower interest rate. Typically, a 15-year rate compared to a 30-year rate, the 15-year rate will run about 0.25% to a full percent below what you would get quoted for a 30-year rate. Now, a lot of people say I like the 30-year term because I can have a slightly lower payment, but 15-year rates are typically lower than a 30-year rate. So shorter terms get lower rates. Longer terms are more risk. They'll come with higher rates. Next, Fixed rate versus adjustable. Is your loan fixed for 30 years or is it adjustable? Adjustable loan programs will typically start out with a slightly lower interest rate, but potentially could notch up above that fixed rate. So that's another factor. So in summary, your credit profile, how much you're putting down, the use of the property, is it a vacation home, investment property, or your principal residence? Next, is it a condo or a single family? Next, the loan term, how long are you borrowing the money for? And number 6, is it a fixed or adjustable rate? With the answers to those questions, your loan officer can give you a much better idea about what your interest rate will be. So what's the solution? First, get pre-qualified. Get pre-qualified with a local Phoenix mortgage loan officer or bank or credit union, and you might even float 2 or 3 different loan applications. And then get your pre-qualification, go shopping, write an offer, have your offer accepted, and then call those lenders back and say, I'm ready. You know my credit, you know my down payment, you know the loan program I want to use. This is a single-family residence. This is my principal residence. I want a 15-year mortgage, and I want a fixed rate. What is my mortgage rate today if I decide to lock? And they will have the information to quote you a rate on the spot, a very specific rate for your unique circumstances. So I hope that answers the question, why can't I just get today's mortgage rate? My name is David Meek, licensed Arizona real estate broker. Feel free to reach me here in the studio, 480-999-MOVE. That's 480-999-6683. My blog and thoughts on the Phoenix real estate market are at ArizonaReport.com. Thank you for joining me. Tune in for future episodes. Until then, we'll see you.